Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer or endorse any particular trading system, strategy, or recommendation. We are not responsible for any trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is February 11th. Good morning, Andy Lebow.
Good morning, Jim Colburn.
How's it going?
It's going pretty good.
Let's get right into this. One of the main drivers, or the main driver, is still the virus.
Yeah, no question that the virus continues to be it's a big factor in all the markets. I think that what has been so surprising, obviously, in the petroleum markets has been this rally, despite some of the what had been really worsening conditions on infections and hospitalizations. But thankfully, in many areas in the world, those have gone down, and the vaccine is at least beginning to be more widely distributed. So that's all been, I guess that's all been supportive for the petroleum markets.
But let's take the U.S. for example. We've seen many people getting vaccinated, many people getting infected. But are you seeing it show up in demand numbers like gasoline demand, jet fuel demand, things like that?
And therein lies the big point, Jim. Things are improving, but we're nowhere near where we were, nowhere near normal on demand. The IEA just revised downward again first quarter demand and second quarter demand, and look forward to the very strong second half of demand. And what we've seen in the U.S. so far, the demand numbers are getting a little bit better. Gasoline demand still, frankly, stinks. Distillate demand is improving. No doubt about that. I mean, we're seeing distillate demand is running ahead of 4 or 5 year averages, so that's been good on the diesel side. Jet fuel demand, we saw 1 week where jet fuel demand was pretty good. But I don't know if that's just a one-off, Jim,
Right.
or this improvement. I suspect it's just a one-off, and also it's jet kero demand. So kero demand obviously has been helped by the colder weather, and there's also propane demand has also been pretty strong. So we're seeing improvement, but again, questionable in the jet fuel demand, and gasoline demand, as I said, is still pretty poor.
So bringing up gasoline demand, I probably didn't want to get into this right away, but the gasoline cracks were sort of confounding. They kept going higher for a while and without demand. So is it just that the refineries are, able to sort of cut back on production and able to manage the decline that we've seen in demand?
The refiners have done a pretty good job of keeping gasoline supplies under wraps. I think a key factor there, the cracks have been strong. Pad 1, we've lost a lot of refinery capacity in Pad 1, so Pad 1 can from time to time get a little bit tight, but that's going to stop because first of all, refiners have begun to start moving towards making more gasoline. And second of all, the arbitrage between Europe and New York Harbor is way high. So, I would suspect that we're going to start seeing, we'll be seeing, I don't want to say it's an armada, but there'll be a lot of supply coming in from Europe. And we've seen it, and now the cracks have turned over, right?
Yes.
The gasoline cracks have turned over. So, I think that was a short-term phenomena. Gasoline demand getting back, the looking at the 4-week average, it's 7.9 million barrels a day versus the 5-year average of 8.8 million barrels a day. So it's still running 1 million barrels a day,
Right.
Behind normal. And the EIA is saying, well, gasoline demand is going to improve dramatically as we head into the second half. But Chip, that's it, and it may be higher than what the EIA says. They have demand getting up, almost 1 million barrels a day for one of the months in the second half from where we are now. But that's still going to be dependent on a lot of different factors.
Right. And again, with this, I think about the people who have been vaccinated recently. It's the the health workers, the first responders, and the elderly. And it's not like they're jumping on planes or driving cross country. But what kind of indicators are you looking at going forward to kind of give you a sense that of green shoots, or that the part of the economy that's been whacked pretty hard is starting to come back?
Well, first of all, there's all the miles traveled, which is sort of a lagging indicator, but at least it would be nice to start seeing that beginning to move up
Right.
in the right direction. And there's all kinds of mobility indexes that you can look at, whether it's the TomTom numbers or any type of numbers. The ones that I think will tell the tale is you just start looking. Let's keep watching these apparent disappearance numbers. These weekly numbers. Let's start seeing them at least trending in a better direction.
Right.
And and also a lot's going to be what's it going to be dependent on? All right, we need jobs, right? People have to drive to their jobs. So where the stimulus package goes, is going to be important, and how that helps the economy is going to be critical. To get a baseline gasoline demand to begin to get somewhat closer, at least to start growing. And then in the summer and the fall, it'll be where Americans are going to go, right? Where are we going to drive? Are we going to get on planes? Are we going to drive more? And I guess some of that too is going to be how the distribution of the vaccine is, and where the distribution is, and how confident people feel.
Yeah.
Herd immunity. I mean, there's all kinds of obviously things that we'll all be watching.
Right. And it gets back, one of the things that common thread you've been saying since the beginning of this event is that how hard it is to keep supply demand balances up to date. You change them all the time, but you had a really good call early on that demand was not going to be good relative to what the big three, the IEA, OPEC, and the EIA, were saying in their monthly reports. Had they caught up to you, or you still got?
I think they're pretty much caught up to me. They're still the OPEC report just came out as we're doing this, so I really haven't been able to study that, but I think they have finally caught up with me. I mean, some of their numbers, you just knew that they were just way too high. There was just no way that given where we were and given the restrictions, the travel restrictions, their first quarter and second quarter demand was just way too high. Even fourth quarter demand. I think fourth quarter demand may have come in a little bit higher than what I was looking for. So, but yeah, I think they finally caught up to me, and I'm just me. They've got reams of analysts. So You know what, Jim? I feel pretty good about that one.
Yeah, but if you take all their reams of analysts, you probably have more years of experience.
That is, unfortunately, that is probably correct.
So, so you're a little surprised at the price move. Why don't we talk about that?
Let's talk about that.
What's going on? It's in not only the outright price, but the structure is much. We're backwardated now.
Yeah, I mean they're certainly related to a certain extent, not completely. But I mean we've been in backwardated markets where the market's gone the other, has gone south.
Right.
But I think that clearly the market has reacted to drawing inventory. The IEA's report today had us down in second half of 2020 by like 2 million barrels a day. And they see a good draw in the second half, somewhat of a draw in the first half. But you looking at my own numbers, we've drawn hundreds of millions of barrels from. I've got 1.8 million barrels a day draw in the second half. I think I may ratchet that up a little bit. And in the first half, I have 900,000 barrels a day, which one of the banks also had the same amount. So we're drawing stocks,
right?
And that usually is bullish, and the market has reacted to that, and I think as well as some some broader trends in the commodity markets, Jim. This whole reflation trade there may be something, that may have contributed some to our rally, but I like, me, I like to ascribe it more to like the fundamental picture, which has improved. When you draw that much inventory, that's improved. And when you see the structure get more backwardated, that's usually bullish as well. And that to me, we're seeing floating. One thing you could look at right away, point to right away is floating storage.
Right.
Floating storage alone is down like over 100 million barrels over the last few months. And you see that in the Brent market, right? That's right there in the Brent market. That's really gotten, the M1, M2 was like 50 cents, I think, and the year to year is like 40 to 50 cents a month. But the front is gotten tighter.
Yeah. So if you think about fund activity in this market, they're obviously long, but it doesn't seem like they're at capacity. So what's your take on? I mean, they tend to buy the front months and roll.
Right. So I think that's right. I think there's probably some more bullets, to be shot by the funds. And who knows? Last week the WTI was up by 10,000 contracts, which is pretty good. I thought it would be up by 20,000 contracts, given what the price move has been. But I think as you point out, that's only through Tuesday. So this rally.
Last Tuesday,
right?
Yeah.
So wouldn't surprise me that over the last 5 days, another 10 or another 15,000 has come in. The funds are they're there's definitely a lot of bullish sentiment around, not only on on our markets, but other commodity markets, but definitely on oil. There's plenty of bullish sentiment.
Well, there seems to be extreme bullish sentiment on EVs.
Oh.
Right.
Don't get me started.
I know. That's why I mentioned it, to get you started. Yeah.
Well, yeah. I mean, there's a lot of bullish sentiment on EVs, and rightly so. But this is 2021, and that's a few years hence, right?
Yeah.
Where, that's EVs are not having a significant impact yet on gasoline consumption. It's not going to be the difference between, gas hasn't gotten back to normal yet because of EVs, right, in 2021 or 2022. That maybe as we get to 23, 4, and 5, yeah.
Yep. Yeah.
Not this year.
Yeah, I was trying to figure out the speed of adopting new technologies, and I was looking at the adoption of the 3-point shot in the NBA. That was something. It was really, there was no barrier to shooting more threes, and it took. Think about the ABA started it, and now it's like more teams than ever are taking, I don't know, 40% of their shots, some crazy number. But you can track how many 3-point shots were taken, and that was just all you had to do was figure out arithmetic to figure out that this was a good idea. And it took a long time for teams to adopt, and the EVs. I don't have to line up the charts and see which ones. They're getting mandates from municipalities and states and maybe beginning federal as well to buy fleets, and infrastructure is being built. So I'm wondering if it's quicker adoption. And then, like, you're talking about a worldwide event. So the other thing I always think about is that idea is not going to help your March contract, right? If you're trading the next few months out, that's something down the road. Maybe that's affects you buying the equity, the oil stock, rather than the futures that we're involved in. So.
Right. I mean, yeah, we've got to look a couple of years from now to really get into a more serious EV discussion on its effect on demand, because it's right now it's not major. The other thing that talking about the price rally, obviously, why have we been drawing stocks? And even though demand is weak, that's the big question. And the answer is that OPEC Plus has done an unbelievably, surprisingly, shockingly good job of managing this market. And the market was not looking for the Saudi production cut. We were looking for production to be up by 500,000 barrels a month, 500,000 barrels a day each month in the first quarter. And the decision, the Saudis made the decision, well, we're going to reduce, we're going to match demand by cutting output. And they've actually gotten the demand has been good enough, obviously, looking at the price and the expectations for first quarter. Demand has been good enough to still draw stocks.
That's an interest. When the Saudis came out with that, it was almost like, okay, we should be buying this market, but then there was this other part. Did they really do that? Did that just happen? I was really surprised. I mean, I think it took people a couple of days before it settled in and said they're actually going to do this.
Yeah, it was obviously for them, it's worked out, and now the question is, what's next, right? What they have a plan to increase output every month, right? That they made last year, but that was last year's plan,
Yes.
So, and they've obviously proven, given what they did in first quarter here, that they're going to be flexible. And the next meeting is March 3rd, and obviously, March, that might not be the right date, but it's early March. So obviously, that's the next big market moving event. And I guess the question, where are they going to go?
Right. It's they're getting to the price. They're just way away from the volume. I mean, that's all of the oil industry. You're getting, you're getting to areas that are reasonable. Like I think what you were saying earlier in a previous conversation we had, that the 2022 price is around $52.
For WTI.
For WTI. So right. That's not a bad price to lock up maybe, but you need more volume. I mean, they need to be selling more volume.
Right.
And how do you manage that? Obviously,
right.
is the problem.
Right. How do you manage that? And that's I think the market is clearly looking for them to provide more volume. We're going to need it, because if they stay here, then there's going to be, if they stay at these numbers, at this production number, we'll be drawing stocks at a much more rapid pace than what the market is looking for, and that would be extraordinarily bullish.
Right. And since we're talking about OPEC, what's Libya doing? Are they still able to? We were worried about them being able to produce, with a little over a million consistently, and been some problems.
Yeah, I mean, there's definitely been some export problems. They were at 1.3. I think they lost the 200,000 barrels a day on they had some problems with the guards. There always seems to be some ongoing dispute with Libya. I mean, you can't really say that they're a obviously not a reliable producer.
Somebody's not getting paid.
Yeah, yeah. I mean, that's probably what it comes down to.
And they shut down a port or something.
Yeah, whether that, I don't think that's long. They should work it out, or they won't work it out, Jim.
Yeah.
Or they won't work it out,
Right.
and we'll start seeing. We'll see Libya, Libyan production. We'll lose Libya, and that will mean that OPEC is going to have to increase production. And again, we had this discussion. What price do they want? The 50s is good for OPEC, because it might not bring all that much added marginal production onto the market. You start getting into the 60s and close to 70. You're bringing no matter what you are bringing on added barrels from the U.S., in my opinion.
Right. Even with the new administration.
Even with the new administration, you're going to be 70. I think you'll be getting significant numbers, despite what the producers may say about capital discipline, et cetera. Well, why would you be disciplined at 70? Right? There's no reason to be disciplined. If the market goes to 70, you're get me in.
Yeah, and producers want to produce. That's what they do.
Right, producers want to produce, and I'm not saying, hey, the market's going to 70. I'm just saying, if OPEC doesn't increase production, the market will go to 70.
Let's talk about China for a second here. I think the EIA has them increasing demand of like 800,000 barrels over last year.
Right.
And they've been a good buyer in January. What can you kind of describe what's going on in China?
I think their import numbers were excellent in January, their crude import numbers, but that's because December was low, because some of the refiners didn't have their permits for the end of year. I think ran out their import exceptions, so they had to roll some barrels into January. But February looks pretty strong too. So it looks as though demand from China is still strong. I think they ran off some inventory in November and December, but they built a lot of inventory last year. So it puts them, they're really in good shape, because they don't have to buy. I think they have been buying, and we'll see. Now that Brent is in the 60s, if they continue, at the pace the pace for January and February, if they continue into March and April. Now, for end user demand, it's probably pretty good. Let's remember they have new capacity coming on this year, so demand for crude is definitely going to increase, or should increase, and that will probably lead to stronger export demand. And I think end user demand should be pretty strong. 800 is, I don't know, that's a pretty healthy number. I'm not sure it's going to be that, but their end user demand should be good, and their exports could be strong. the thing to watch about China is, we've got to be all over their buying patterns. But as I said, they're really in good shape, because what they did is really what you're supposed to do, I guess.
Yeah.
When the market was on its haunches back last year, near its lows, they just loaded and kept loading and loading and loading. And they, so they built up domestic inventory, they built up strategic inventory, and that's that, per textbook, really.
Right. Right. Moving to another topic, Andy, something we don't talk about too much are HGLs, and I noticed that back in 2010 we were a net importer. These would be propane, ethane, butanes, natural gasoline, stuff like that. And in 2020 we exported 2 million barrels, and then 2021 we're expected to be over 2 million barrels of exports. That's a nice, that's kind of like, I wouldn't say it's immune to what's going on in the rest of the world, but that continues to shine in terms of for the oil industry, right?
Yeah, and to a certain extent, and the natural gas industry, because of the
Right.
Associated gas, or natural gas liquids is what they are.
Yeah.
And a lot of that export demand is propane has been one of the shining stars this year so far because of the colder weather. The propane, I think I mentioned, propane demand has been strong, and propane export demand obviously has also been very, very strong. Ethane demand as well. Which petrochemical demand globally did okay last year. That wasn't the real problem. The problem was in the transport fuels, and petrochemical demand is going to continue to grow. That's one of the bright lights for the for the fossil fuel industry is petrochemical demand should be strong, for the next few years, and we're seeing all these crackers being built globally. So yeah, that's good news for for the fossil fuel industry. Maybe not so good for the environmentalists, but plastic is still very strong global demand for plastic and for petrochemicals.
I think it was last month. I don't go back and listen to what we say,
Kidding.
No, I don't. And you had talked about you wouldn't be surprised to see prices rally, but you thought that, I think we were around $52, $53. You kind of thought they would stick around that level. We've bumped up some, and like I said, it wasn't like you said it can't happen. But what are you looking for with, say, the next couple months and with WTI prices and I assume Brent as well?
Well, we said in our last monthly that we thought momentum could get WTI to 60 and Brent into like 62, 63.
Right.
Something like that. And we're just, to use your analogy, Jim, we're like a 3-point shot away from WTI getting to 60.
Mm-hmm.
And could it go past there? Yeah, I mean the funds may, as you also mentioned, Jim, there's capacity for the funds to come in. So yeah, there could be even more upside. But then, we're coming right against that OPEC meeting, and very soon people are, that's going to be the focus in the market. What's Saudi going to do? What, production, how much is production going to increase? And also, there are a lot of demand traps all over the place.
Right. I like that phrase, demand traps. I like that. I'll steal that. Thank you.
I used it in our monthly.
Okay.
Which is available if anybody would like.
Yeah.
Just hit us up on our website, or Lebow at commodityresearchgroup.com. But yeah, I mean there are demand traps everywhere. So, I think it's been interesting over the last week or so. A lot of the like merchant traders, some of the big merchant traders have said that they think, the prices may be ahead of it, might have gotten ahead of themselves. And I tend to agree. I think prices are, have gotten ahead of themselves. So it wouldn't surprise us. I mean, we said in the monthly that we thought, the market was better. Really, I hate to use better valued, but I was thinking mid 50s for WTI, maybe a little bit higher is where the market, I think is the right price, but there's never any right price. It's what the market price is, right, Jim?
That's correct. That's definitely, there's no new normal because there was never an old normal.
Right. I
Right.
mean, the price is what it is on any given day. So,
Yeah.
if today, if it's 65 and it's 65, but and there's definitely a lot of bullish, there's obviously a lot of bullish momentum in this market.
And gasoline prices?
Gasoline prices, it's hard to be particularly bullish on gasoline prices. We see inventories building. Europe is, Europe can easily supply us. The refiners are, returns to gasoline was way more than what refiners probably had hoped, had expected. So I'm not that bullish on gasoline. Diesel, diesel's inventories have built here. That may be a slightly better story. Obviously, we're getting some cold weather. That's certainly gonna help. So diesel cracks may hang in there.
I still
And
see the delivery trucks on my street daily.
Jim, you just took the words out of my
Oh,
mouth.
sorry.
I was just going to say the same thing.
Yeah.
I was just going to say these Amazon trucks are like still all over the place.
Yeah.
And the manufacturing sector has been good, and manufacturing and distribution. So there's still a good, diesel is still a much better story than gasoline.
So going forward, we're going to look at these. I look at this site called Worldometer, and it updates the the viruses and the new infections, and the trend is it's down. It's coming down from a very high number, but at least it's going in the right direction now. We have this OPEC meeting March 3rd, and then I guess we'll be looking at the weekly DOE numbers for any kind of bump up in disappearance, I guess, in gasoline or jet fuel, all the demand. They call it product supplied, but in those areas, what are you looking at, Andy?
Well, you also, Jim, you were looking at the TSA numbers for
Yeah, right. I look at the TSA numbers and I also look at the turnstile numbers somebody puts out for New York City, and both of those numbers are showing no green shoots, so to speak, as of yet. But I'll continue to be optimistic that sometime down the road we'll have people flying again and traveling on the subway. But
yeah, let's hope. Although I think business travel is, jet is probably, and everybody, this has been the big three's talked about it, and all the bank reports have talked about jet fuel still being, 22 or 20, we won't get back to normal by 22 or 23. Gasoline demand too, the EIA doesn't have us anywhere near normal, until 22 or 20. Well, they've only put out through 22, but
yeah, I mean, my personal anecdotal idea is once I get my vaccination, which is supposed to be in March, I'll probably do a major driving trip before I fly. I'm not, I'm not sure yet, but that's. I think there are some serious driving miles in my future, in my near future, and then maybe down the road, I'll fly somewhere. But I think we might see a delayed but intensive driving season as we come out of the summer.
I think you may be right. I mean, people may not want to, still may be loath to get on an airplane, but they definitely have. I mean, who doesn't have cabin fever? So, so, yeah. I mean, we may see as as they get to the mythical herd immunity, which I guess some of the models have by July or August. Yeah, people may just take to the roads. Say, get me out of here.
And
Anywhere.
one final thing, Andy, for me is, when we had the floor trading, I was thinking about this. What was it called? GameStop, where people went crazy, they buying it up, and the shorts had to cover, aggressively. I said, did we used to call these people locals?
Right.
They would go. The locals are buying, and they hit stops, and the stops are going crazy, and I don't know. It seems like a different, same idea, running stops or running.
Right.
Shorts.
Right. The market's just getting completely out of control.
I
Right.
apologize to my local friends. I feel
go, right. Look at 2008 when we got up to 147.
Oh boy.
On, one of the all-time, I don't know, great squeeze.
Yeah, we had people calling for over $200.
Yeah,
some
yeah,
famous.
that's what got the 200. Yeah, right.
Yep. Anything else you want to add, Andy? With this, again, there's a lot of uncertainty in this marketplace. Stocks coming down. It's hard to get too short on this thing, but we have a lot of uncertainty going forward.
Yeah, we have a lot going forward. We need we'll see what the supply side is going to look like. We'll see, where U.S. producers come in. The EIA in the short-term energy outlook actually reduced their expectation for production by, I don't know, 50,000 barrels. I think they're too low. I think it's gonna come in higher for. They basically have 11 million barrels a day all the way out till fourth quarter.
Right.
I think it's going to be higher than that.
Yeah. Well, you are a little skeptical of the discipline that producers might have.
Well, it's hard not to be after all these years in the oil business, Jim.
They're really optimistic folk. We have to.
They really are.
They're really fun to work with. Yep.
Yeah, great to work with.
Yeah. Okay, great, Andy. I'll talk to you next month.
Okay. We'll see everybody next month, and if you want to get a hold of us before that, check our website at commodityresearchgroup.com. You can get me on email at alebow, ALEBOW, at commodityresearchgroup.com.